Welcome to TheoTrade. This is Don Kaufman. It's October 15th, 2018, and you are watching the Theo Night video. There's 4 minutes left inside of today's trading session. S&P futures are down about 950 after a session of trade that can only really be described as kind of scattered and broken. You know, one of the things that I look at in a trading session like this is some unprecedented volatility hits the markets last week. Today feels like things kind of died down a little bit. We had a very large overnight trading range. For those of you that missed this, the overnight trading range took us all the way down into the neighborhood of about 2745, only to see us rally back up prior to the cash open. At the cash open, we faked lower, headed higher. As I said, kind of felt a little scattered or broken. Maybe a little bit of sell-side activity coming into the S&Ps kind of late in the session. Obviously, the Nasdaq is down by another 1%. But the big question that kind of persists, is it going to be rally time or is there going to be more sell-side activity? And I'm going to tell you something. Yes, to ultimately both of those, but there's one aspect that I want to show you that you may miss, if not necessarily pointed out. So for that, we're going to cruise over to the SPX. And the SPX, the grandfather of all products out there. I mean, this thing, it's really a monstrous size product. I mean, it's like trading almost like a $2,800 stock. Nevertheless, the reason I bring up the SPX is over the weekend, we had a fairly substantial expected move. And again, I'm not going to go too detailed specifically into this last expected move, but the expected move of the weekend was plus or minus. It's about $71. Okay. You know what? That's neither here nor there. We have an expanded expected move simply because we saw volatility hit the markets last week. Right now, though, if you look right now, okay, put everything aside from this weekend, forget about last week. You're interested to know, is there more volatility about to unfold? Well, okay, to figure that out, stop looking at the MACD again, the Fibonacci and the Bollinger Band, and start looking at things like implied volatility. What I want to bring up to you, I'm going to freeze the screen for just a second. Cruise out to the October 19th expiration. That's the Friday, and look at the PM settlement. The Friday PM settlement expiration, and we have about a $56 expected move. Now, don't worry about the expected move. Put it aside for just a second. Look at the implied volatility. The implied volatility is about 22.5%. So the question is, okay, is there more volatility that is in the works for this week? Okay, given the fact that today's trading session was, again, a little more scattered, a little more broken, maybe you kind of feel like volatility is down. Well, there's an answer for that. Compare the Friday, okay, right now, compare the implied volatility from today to the implied volatility from this weekend. And it'll tell you, okay, a huge story about this marketplace. And here it goes. This now is what we're looking at. And again, I'm going to close up this left side bar just so you can make sure that you focus on this. This happens to be from over the weekend. Okay, so this was from Friday's closing price. And if you look at the 5-day, okay, this is assuming that, today never even happened. We didn't know about today. Listen, there was a $71 expected move. We mentioned that already, but I want you to see there's a 22.65% implied volatility. Right now, live, there's a 22.71 vol. This speaks absolute volumes. You're looking at a trading session, you're like, okay, it's safe to come out again. I'll put my toe back in the water. You better watch out because from Friday's close till right now, they've actually bumped the volatility ever so slightly higher. So what are they saying about the remainder of this week? Is there 7 seconds left in the trading day? They're saying, oh no, we're going to rock your world the rest of this entire trading week. There's the closing bell. They're going to rock your world the rest of the entire trading week. And the SPX, there's one, thing about it. There's $1 billion+ that are traded in these options. I don't believe that. All you got to do is go look at volume and open interest. The volume and open interest, it's nothing less than staggering inside of this marketplace. Look, open up a full option chain. Scroll through it sometime. Don't take my word for it. Look, 28,000 contracts open here. There are billions of dollars, okay, being traded in this marketplace, all pointing towards one thing. Okay, an implied volatility. That's what option pricing is really about. Option pricing in the end, it's all about implied volatilities, right? And they're pricing in now more risk for the remainder of this week. So when I ask that question, kind of rally time or more sell side activity, the answer is, oh yeah. Okay. But the difference is we're going to be stepping up and selling. Okay. And selling some out of the money premium into those rallies. Let me give you an example of just that. Okay. Let's, for argument's sake, say that something like Amazon rallies a ridiculous amount on Tuesday and Wednesday of this week. All right, so we're heading into obviously Tuesday, and I just want to draw this up here because, again, I want to make you prepared for either side of trade. Okay? There's no predictability on a day-to-day basis. As I said over the weekend video, all we have is levels to go off of. But assume that Amazon, okay, were to make a bid back to the upside. Now, granted, there's earnings coming up, and you got to avoid the earnings because we don't want to sell. Okay, we don't want to sell premium in the expiration that has earnings. Why? Because the options won't decay. They're going to sustain high volatility. But we could sell, okay, some premium with just the remainder of this week. So let me again give you this example. Let's say that Amazon exploded back to the upside. I mean, literally explodes back to the upside. Very possible that we see Amazon easily hit the 1800, okay, maybe 1825. We might be able to sell premium way out here. Okay, so we're going to sell some out of the money premium. Why? Because the volatility is elevated. All right. Look, if you're into, like IV percentiles, 87th percentile. But again, there's earnings coming up next week. But you can sell premium with just 4 days remaining. And I got to tell you, the Amazon options, they are juiced right now, people. All right. What I'm saying is there's a whole lot of premium in those options with a very short period of expiration. So we come out, we fish around under delta. So if there was a big rally, we're going to look to sell an out of the money call spread. Okay. If again, sell side activity persists in the next couple of days, we may be looking to sell again, just in the next 4 days. Okay. In the next 4 days, we'll sell some put spreads. Why? Expanded volatility. There's a $70 expected move in Amazon, right? Inside of the next 4 days. Now, this doesn't construe that Amazon is the only product that you can consider. Okay. Far from it. Everything is looking like this right now. Okay. There's underlyings like Google. They've been trading in one direction. And listen, with something like Google is very likely to see some more sell side activity. Nevertheless, you got to look as the bid back to the upside as being an opportunity, okay, to short. And right now, we can't even get the bid back under us. All we keep doing is let's sell off. Okay. Every little ounce of turning green is being hit by some sell side activity. But I will reiterate the stance that the hallmark of some of the most wild, markets isn't necessarily just the down moves. It's the rip your face off rallies that are so intense. That's where people often get hurt. They'll turn around and try to short into this marketplace only to see the market get bid back up. That bid back up, sure, it's some dip buying, but more often than not, it's shorts, that are covering, that's shorts that are buying back, and they re-up to hit them again and sell again another day. Keep this stuff in mind in the days to come, but I want to set you up kind of categorically a few strategies. Now, here's some of my own positions, some of my own trading. Okay, back to the S&Ps for just a moment. I've got levels, all right? Now, as I said, kind of categorically speaking, I'm already short the markets. Okay, I'm short the market. So when I see the S&Ps down 16 or the Nasdaq down 100, I'm good, right? Let ride, like let them fly, because I'm carrying what I term long duration or duration short positions. So my position, my net position right now is what we term negative delta. What that effectively means is, I'm short. But again, when I say those are duration positions, those are not positions I'm in, I'm out, I'm so in, I'm out. Those are positions that I'm going to sustain for large moves to the downside. So on a day-to-day basis, I don't have to necessarily go after the shorts. Okay. When we do, though, get that rip and bid back up, it's another opportunity, to play whack-a-mole. It's another opportunity to re-up a couple of shorts. And that's often where I find some opportunity. Now, as I was saying, again, the other day, and I've labeled on my S&P futures, we've got, again, 2911, 2842, 2811, 2731, 2682, and so forth and so on. These are levels that you can expect. Again, these are levels that you can expect. The S&Ps, as I say, to be pinging back and forth, okay? It would not surprise me at all to see, of course, the 2731 make an appearance throughout the course of this week. However, okay, I'm also very mindful that we'll probably see 2811. Both of these, if you do take a look specifically at the SPX, now we're going to go take a quick glance back over at the SPX, okay? That kind of movement is well, okay, in line with what the SPX expects for an expected move. Now, I want to switch gears for a moment and not necessarily worry about pinging back and forth between levels. I think people get it, all right? When I said we're going to be pinging back and forth between levels, maybe you don't even want to sell some premium in Amazon. You can come right here into the S&Ps. When we hit something like 2811, you can go out and sell premium just as long as it's above, probably 2842 in the S&Ps and vice versa. If we sell off hard, I mean ugly, and we get all the way down to 2682, sell some out of the money put spreads, okay? It's going to be, again, it's a trader's market, right? There's some premium to be sold out there. The VIX, hey, at least it's sustaining 21. I know it's just kind of catching its stride, but that's a heck of a lot more exciting than a VIX of, 11. So we'll take what the defense effectively gives us in terms of selling some premium. Now, as I said, kind of switching gears, let's cruise over to the financials, the XLF. The XLF is absolutely torturing us. However, a key level, 2650. If you look at this on an intraday trade, tell me 2650 doesn't make a whole lot of sense. We broke off it, though, in late trade today. Now, in the morning, and again, it's Monday afternoon in the morning, we're going to hear from the likes of Goldman Sachs. Now, if you haven't looked at a Goldman Sachs chart over the last 9 months, or here, for the better part of, recent history, okay, it's starting to get ugly out there. Goldman Sachs is probably at a critical threshold. Goldman Sachs is going to have earnings in the morning, obviously going to threaten the financials substantially, okay? But Goldman Sachs, the reason I'm keying into it, you got to think more about the Dow at that point, okay? In terms of components in the Dow. Now, this is something, again, that we have mentioned from time to time in here, but Goldman Sachs, okay, when you start looking at it, Goldman Sachs is the fourth largest component inside of the Dow, meaning it's the fourth most important stock inside of the Dow. Goldman Sachs releases in the morning, and you could have a Dow that is absolutely rocking. Now, Goldman Sachs, it isn't expecting anything astounding. It's about an $8 expected move. But an $8 expected move in Dow terms, it's the equivalency of about 60 Dow points. So the Dow, okay, tomorrow is probably going to have 60 points of flex just from Goldman Sachs. In addition to Goldman Sachs, another financial is going to have earnings in the morning. Has to do with Morgan Stanley. Okay, last but definitely not least, we are going to hear from earnings from our very first tech company. This is tomorrow afternoon. By the way, the S&Ps, they got smoked into today's close. Very unexpected, but the S&Ps now are down 20 handles. Okay, come back to that in just a second. It's one of the reasons I like to record this right into the cash close. But when it comes down to Netflix, one of the first tech companies, and I'm not bringing up Netflix per se to build a trade. First of all, the implied volatility and the expected move in there is very substantial in comparison to previous moves, okay? In the previous earnings announcement, Netflix, okay, the expected move was exactly the same. It was $33, but the difference was it was a $400 stock. So right now, Netflix is expecting a 10% move higher or lower, okay, after the bell on Tuesday. This is one where, normally I'd go, you should sell some premium. I'm going to step back from Netflix, okay, kind of let sparks fly. But the reason I'm pointing out Netflix is there's another major tech company that's possibly, okay, in under some duress. It's actually going to be Apple. There are reports right now, okay, that Chinese demand for the iPhone has fallen off of the edge of a cliff. And this is why Apple is down 2%. However, okay, even good earnings in the last 24 hours has been met with sell-side activity. And that's why, and again, I'm not comparing Netflix in any way, shape, or form to Apple. But we want to see, is Netflix going to have decent earnings and the stock still fall? If you're looking for an example of just that, look no further than Bank of America that absolutely smoked their numbers. The stock fell by the tune of almost 2% today. Bank of America beat. Go ahead, take a look at it. Read every report you possibly can, okay? Because they beat, okay? They even gave good projections moving forward. But all of a sudden, okay, the rhetoric has completely changed in this market. And they turned around and the marketplace said, well, that was already priced in. We were expecting them to beat. Now they have to beat plus and then some. And therein lies an issue as we start to look at Netflix or even Apple. Now, Apple is still out almost 2 weeks from now. Nevertheless, it is becoming absolutely critical to keep eyes on this because Apple, in the midst of all this sell-side activity, okay, remains still rather unscathed. Again, a lot more trade this week. Expect substantial volatility. Okay, expect some rip-your-face-off rallies. Take advantage of it, people. This is trade that we haven't had in quite some time. Sell some premium on the rip and rallies. Okay, buy that premium back if we dip away from it. If we see some sell-side activity, you might be able to sell some iron condors. We turn around, we rally back up. The volatility gets crushed, buying back those iron condors. Lots of opportunities start to emerge in the midst of a market moving. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.